How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic I want to discuss with you index universal life and use that primarily as a retirement income or retirement supplement for those later years and how to really delve into some of the specifics and how you can set up a plan for yourself or at least instruct an advisor on how to set this up correctly. And first off, with the title, a lot of times you have agents that will look at this and they'll say, there's no way in hell that I would ever put anybody in an IUL product for retirement or as a retirement supplement. And they just simply do not realize how these types of things work. The only time that I ever recommend these types of platforms with an index universal life insurance is when you're doing it's known as an overfunded cash value maximization strategy. I never try to half-ass it with an IUL that is primarily for a death benefit need, so that you're getting a little bit of death benefit, a little bit of cash value. Those types of policies never work, or they will not work most effectively to what that individual's goal is. There's a better route to go. If someone's looking for a max death benefit and a permanent death benefit, there's a more effective route to make sure your dollars are going towards that max death benefit. If you're looking to place your dollars into cash value and utilize that cash value for a retirement supplement or for something that could combat a type of 401k account or a type of IRA, Roth IRA accumulation, there are ways on how you could do that, but you have to structure this plan a specific way to receive tax-free growth, tax-free income, and then at that time when that person passes away, there's a tax-free death benefit that's still waiting there, but that tax-free death benefit has to be the least of their concerns. So basically, what we're trying to do is punch as many holes into that death benefit, strip away that cost in the death benefit, so you have a lot more dollars that are accumulating, each and every year, each and every month into that type of plan. So the problem that lies is you have a lot of insurance agents out there. You have many thousands of insurance agents that are licensed, and they get whiff of a index universal life plan. They understand that you could grow your monies tax-free, pull your monies out tax-free, and then leave a tax-free death benefit, and they're sold. And they're saying, wow, this is the greatest thing since sliced bread. And it's not so fast because you have to understand where the premise is, what's going on behind the scenes. What is the insurance company? How are they trying to become profitable? What is the risk on their books? And therefore, how do they transfer that risk directly over to the individual that's trying to place his money into this type of plan? So many times, and it's taken me personally many years to really figure out this moving part and then hone in on the negatives. So when I'm honing in on the negatives, I'm saying, okay, well, which will be the best carriers that will give that individual the most amount of growth so that we could strip away all those negatives most effectively. And the carrier definitely does make a difference. I mean, you have, let's say in a given state, if you have 50 to 100 of these types of product lines, 95% of them are complete garbage. I would never recommend it. I would typically go through a Rolodex of about 1 to 5 companies, and then there's specific product lines of those companies that I would ever recommend an IUL. And case in point was my brother's actually in the industry. He's on a different side of the business. He does more of the property and casualty, like the auto insurance, homeowners insurance, all of that. So he's a captive agent, and we were just having a conversation last week, and he was saying, oh, well, I kind of heard about this IUL thing, so I compared my best product line against his current product line, and the difference for the client with mine was giving the individual about $84,000 of income from ages 60 all the way to age 100 of tax-free income. And his contract was giving him about $29,000 of that same from age 60 to age 100. And we were structuring the policy very similar. It's just I was using a better product. I was using one that allows me to manipulate that death benefit, manipulate the cost of insurance a lot easier. And it's astronomical, that difference when you set it up with the correct route. So let me clear up the screen real quick, and I'll go into some of the different things that individuals fall victim to, and then I'll show you how the premise behind a cash value maximization plan works, and then some just further specifics on how a carrier can make a difference in net amount at risk, the cash value corridor, all those fun little topics. So what this sort of illustration is a typical permanent life insurance policy. And what happens is you have a death benefit. Let's say if somebody's throwing in $1,000 into this plan and they have a $500,000 death benefit. Well, this death benefit is going to be the net amount at risk to the insurance company. So they're saying if this person pays $1,000 and then croaks, well, then now we have to take 500 grand, take it off our books and give it to their beneficiary. So that's a large risk. This is known as the net amount at risk. So the larger that this death benefit is, the higher that this red section is going to be. And this is COI, cost of insurance and other expenses. So with all these different cash value plans, what happens is after the cost of insurance and other expenses are paid off that go towards this net amount at risk, whatever's remaining kind of goes into a type of savings account known as cash value. So that's that little green section over there. So usually what would happen is that a life insurance agent will say, hey, go into this permanent death benefit plan. We're going to make sure that this is maximized out to 500,000 of a death, and this is just a hypothetical example, 500,000 of a death benefit. And the great news about this is you're going to have a little thing called cash value that you could pull from and use as supplemental retirement income, and it's going to be tax free and all these great things and rainbows and butterflies, et cetera, et cetera. As you could see with this slight illustration, the cash value is getting eaten up by the large cost of insurance and other expenses. So we want to, if we're looking at a cash value maximization strategy, we want to make sure that there's more green in there. So a really quick fix would just be reduce the death benefit. If you reduce that death benefit to, you're still putting in that $1,000, but now instead of a $100,000 death benefit, instead there's a $500,000 death benefit, we reduced that down to a $100,000 death benefit. So what did we do? We lowered the net amount at risk. So therefore, more dollars, this is known as a slight overfunding. So therefore, less dollars are going to the cost of insurance and other expenses, more dollars are going to that little savings component known as cash value, kind of like a savings account. And net amount of mess, NAR. So what we try to do with our policies is say, okay, well, what are other factors regarding the net amount at risk? How exactly can we make sure that this death benefit and this cash value is as close together so that we have very skinny cost of insurance and other expenses? It's very little net amount of risk to the insurance company because we're not interested. If you're going to go and try to set up a cash value maximization plan, death benefit is going to be the third least of your concern. So basically, you want to make sure that you're having max cash value. You want to make sure that you're able to pull max tax-free income from that, and then you have a death benefit that's sitting there. But that's going to be, the third tier is going to be the death benefit need. So that's what we're trying to manipulate when we set up these types of plans. So that's why with our plans, we look something like this, where you're saying, okay, you're still throwing in that $1,000 rather than that $500,000 death benefit. What we do is we set it up on an increasing death benefit, and then we eventually level it off to make sure that this cash value and the death benefit are as close to each other as possible within legal limits. So that you do not, there's a technical term known as modified endowment contract. You do not mech the policy and turn it into a regular retirement account. There's a way to kind of stay underneath the radar, and it's something known as the cash value corridor while making sure that that net amount at risk is much lower. On top of it, another thing that really affects that net amount at risk is if you have company A that is paying this $100,000 death benefit as a lump sum, or company B that is able to pay this death benefit out in up to a 30-year time frame, well, company B is going to have a lower net amount at risk at company A. Company B is going to have lower expenses than company A would. So what we did was we found what the best carriers were that allows us to manipulate the death benefit, how that actual benefit gets paid out to beneficiaries rather than a lump sum that has a larger net amount at risk. We utilize a lower net amount at risk through a more of a annuitization option because, once again, the death benefit is going to be the least of the concerns. Yes, the beneficiaries would still receive a tax-free death benefit, but how you can stretch out that death benefit has a very large impact to how much cash value is going to be growing into that type of plan. So once again, the dollars are going in, it's paying for that net amount at risk. It's paying for this cost of insurance and other expenses, and then you have another portion that's going into that cash value. So if you look at this cash value kind of as a little like funnel bucket, those excess dollars are going into the cash value, and then how this interest credit is added to that bucket also grows the bucket as well. So that's why I like to utilize the index universal life route, because it's known as an indexing strategy that will pay when depend upon which indexes or which product line you're in. Like let's say if you have an S&P 500 or you have like a blended index or a Barclays index, whatever that case may be. Let's say if you have something that has like a 17% cap and the market gains 20%, well, you're going to gain 17% of additional growth onto it. Let's say the market crashes minus 20%, well, you have a floor of 0%. So you have a cap and a specific floor, and they're very high with these certain types of product lines. So that's why I like to leverage, not only try to manipulate and get the most amount of net that's going in this side, but how do we always have a positive interest, the power of compound interest always working positively on this type of bucket so that we have a lot of cash value. And then when it comes time to take withdrawals from this account, there's different options on how to pull those monies out on a tax-free basis on either a fixed, it's known as a fixed loan provision, a variable loan provision, or an index loan provision, and you want to see a carrier that has all three of those features. And it's the combination of all those different things that gives us a lot of leveraging for a really good maximized retirement supplement. So with a lot of individuals that are looking to save up for retirement, when exactly do these things work? And my rule of thumb in office is saying at least 7, at least 10 years before you want to start triggering incomes. If you're looking to do this within like 2 years, 3 years, 5 years, even within 10 years, still is a little bit sketchy. I like to at least wait 10 years. So if somebody's like 50 years old and they're saying, okay, I want to retire at age 65, well, this might be a good solution. If somebody's in their 30s and they're looking to retire in their 60s, that's a fantastic solution because there's a lot of leveraging components that we could do, and you're utilizing such inexpensive costs and you're overfunding the heck out of the policy with that power of compound interest that's just astronomical. So what we try to do is hone in on the taxes. Is this type of account growing tax-free? Can you pull your monies out tax-free? Will it leave a tax-free death benefit? Inflationary protection. Something that will at least combat inflation. If inflation's increasing by about anywhere from 2 to 4% in a given year, something that will at least gain with the market when the market goes up, not lose when the market goes down. Then you have market losses. So try to prevent those downward market losses like in 2008 when individuals had half their portfolios wiped away. If we have a minus 50% on the indexes, well, we have a floor of 0%. So you're not going to have that large downfall like a variable universal life policy will. And then the expenses. So we actually use a tool, it's known as a Retire Sharp planning system, where we're able to pinpoint if someone's getting set up in a brokerage account, how much in fees they're going to be paying in that brokerage account, how much in fees is that going to be when you're versing the brokerage account versus the IUL, the 401k account versus the IUL, the Roth IRA versus the IUL. What exactly happens? So we're taking a scientific approach rather than just saying, oh no, trust me, it's in there. It's saying, no, in the first couple of years, the IUL is going to be more expensive, but because you're waiting that 10 years, there's going to be a specific break-even point where that other account is going to be a lot more expensive, especially in those later years. And with all these other variables, when you structure these policies the right way, the math comes in and it makes the IUL more successful than the other route. Now, there are times that the IUL is not as successful, and that's when we would never recommend it. If someone's unhealthy, if somebody is, looking too short of a time horizon, if they're looking to go with a specific carrier, when I know that that carrier is a garbage product, that's when we're not going to, give that recommendation. But we try to show everything from soup to nuts. We even tell you guys exactly what we're getting paid on a commission standpoint. So you're not saying, oh, well, you're just trying to put me in this product to make a commission. I'll tell you exactly if I was to manage your money, how much I'd get paid or how much I would get paid by setting up an IUL the correct way. And trust me, the IUL is going to be making a bunch of difference when you structure this the right way and you're taking away the cost of insurance and expenses because that's going to be dipping into agent commissions. We'd rather have more clients that are happy, that are satisfied, that are with us for the rest of their lives than just penciling them into a product and never hearing from us again. So, that's kind of the way that I've structured the company, and that's how I train all my agents is to utilize these types of strategies. So in closing, if you found value in this video, please feel free to give us a call. It's 1-800-566-1002. We're available 24 hours a day, 7 days a week. We have it on mornings, nights, weekends, holidays. We will be available. Someone will take your call, and then depending upon the specialist that's in the office that day or whichever specialists are in the office, that's where the assistant's going to patch you over. So you go call the 800 number, speak to the assistant, tell them that you saw a video online and you were interested in index universal life insurance for retirement, and you wanted to talk to a specialist to get some further information. And we try to educate you guys first and foremost. It might be a good avenue, it might not be a good avenue, but it's definitely worth realizing. It's not something to completely take off the table. Just like I would never take off if someone's trying to grow their monies into different types of brokerage accounts. Yes, I have a more conservative mindset, but it's just how many tools in your tool belt can you utilize for proper retirement, so you have these mini buckets that are sitting there that you're able to execute when that time comes for retirement, and have confidence in retirement to prevent that downward market losses and all those different variables. So thank you so much, guys, for listening, and make sure to subscribe to the YouTube channel Retire Sharp so you can have access to my most updated videos. Thanks so much.